If you're a federal employee and you're not sure whether to go with Roth or traditional TSP, this could cost you hundreds of thousands of dollars in retirement. And I don't say that for dramatic effect. I've run the numbers, and the tax differences between these two choices can seriously impact how much of your money you actually get to keep later. In today's video, we're doing a deep dive into the Roth and traditional TSP options. I'll explain how each one works, when to use which, and how your tax bracket, both now and in retirement, should shape your strategy. We'll also go through a real-world side-by-side example that shows the difference these choices make. And toward the end, I'll share some advanced strategies like Roth conversions and how to split your contributions for maximum flexibility. Whether you're just starting your federal career or already a few years from retirement, this video is going to give you clarity and help you avoid mistakes that could cost you tens of thousands of dollars or more. So let's get into it. Let's start with the Roth TSP, because a lot of federal employees have heard of it, but many still aren't sure how it actually works. When you contribute to the Roth TSP, you're using after-tax dollars. That means you've already paid taxes on that money before it ever goes into your account. So you don't get a tax break now, but the big payoff comes later. Once your money is in the Roth TSP, it grows tax-free. And if you follow the rules, you can withdraw it in retirement completely tax-free. That includes both the money you put in and all the investment gains. That's a powerful tool, especially if you think tax rates are going to be higher in the future, or if you're working toward early retirement and want more flexibility with your withdrawals down the line. Now, one key thing to understand is that the Roth TSP is not the same as a Roth IRA. Yes, they both use after-tax contributions, but the Roth TSP has different rules. For example, the Roth TSP does have required minimum distributions starting at age 73. That's unlike a Roth IRA, which doesn't require you to take anything out during your lifetime. However, you can roll your Roth TSP into a Roth IRA after you separate from federal service. And doing that eliminates those required distributions, which is a great strategy if you want more control over your retirement timeline. The Roth TSP is especially useful if you're early in your career and in a relatively low tax bracket. You expect to earn more money in the future, which means your future tax rate could be higher, or you're pursuing FIRE and want access to tax-free income down the line without worrying about big tax bills in retirement. Bottom line, Roth TSP gives you tax-free growth and tax-free income later in exchange for paying taxes now. If that trade-off makes sense for your situation, it can be one of the most powerful tools in your retirement plan. Now let's talk about the traditional TSP. When you contribute to the traditional TSP, you're using pre-tax dollars. That means your contributions reduce your taxable income for the year, which gives you a tax break right now. Let's say you earn $80,000 a year and you contribute $10,000 to your traditional TSP. Instead of paying income taxes on $80,000, you only pay taxes on $70,000. That can be a big benefit if you're in a high tax bracket today and you want to lower your current tax bill. Once your money is in the traditional TSP, it grows tax deferred. That means you don't pay any taxes on the earnings while it's growing. But, and this is key, you will pay taxes when you withdraw it in retirement. At that point, every dollar you take out is taxed as ordinary income, just like a paycheck. So the traditional TSP is really about deferring taxes, taking the deduction now, growing your investments, and then paying taxes later when you start pulling the money out. This works especially well for people who expect to be in a lower tax bracket in retirement. For example, if you're earning $100,000 now and expect to live on $50,000 per year in retirement, you could save money overall by delaying those taxes. The traditional TSP is often a good fit if you're in your peak earning years and want to reduce your tax bill today. You expect your retirement income to be significantly lower, or you're trying to max out contributions and want the current tax savings to help with cash flow. One caution, if tax rates go up in the future, or if you end up having more retirement income than you expected, you might find yourself paying more in taxes than you planned. Also, just like with Roth, the traditional TSP requires you to start taking required minimum distributions at age 73. Those withdrawals are taxable, and they can impact your overall retirement tax picture. So the key idea here is, traditional gives you the tax break now, but taxes everything later. Roth flips that. You pay now, and you withdraw tax-free later. Which one works best? That depends entirely on your personal tax strategy, and we're going to break that down next. So now that you understand how Roth and traditional TSP work, let's talk about when it actually makes sense to use one over the other, or even both. We'll start with Roth TSP. Roth makes the most sense if you're in a lower tax bracket now than you expect to be in later. That's usually the case if you're early in your career, earning a modest salary, expecting your income to grow over time, or working toward early retirement and want to control your tax burden later. It's also ideal if you're planning for FIRE or financial independence, retire early. Why? Because in early retirement, you may have multiple sources of income. Rental properties, side businesses, investment withdrawals, and every tax-free dollar helps keep your overall tax bracket lower. Now, let's talk about traditional TSP. Traditional is typically better if you're in your peak earning years and want to reduce your current taxable income. You expect your retirement income to be significantly lower than it is now, or you need to maximize cash flow today, and that tax deduction helps. For example, if you're making $120,000 a year and contributing 15% to TSP, using traditional could save you thousands on your current tax bill. That money could go toward debt repayment, investing in a Roth IRA, or funding a side business. But there's also the middle ground, what I call the tax diversification strategy. Instead of trying to predict the future perfectly, some people split their contributions between both Roth and traditional. That way they give themselves more flexibility down the road. For example, in retirement, you might pull from your Roth bucket to avoid bumping into a higher tax bracket, or use traditional withdrawals up to a certain income threshold, then switch to Roth. The truth is, no one knows exactly what tax rates will be in 10, 20, or 30 years, so having both types of money available, tax-free and tax-deferred, gives you more control when it matters most. Here's how I think about it. If you're just getting started in your career, lean towards Roth. If you're 10 years or less from retirement and in a high income bracket, lean traditional. If you're somewhere in between or unsure, do a mix. That gives you options and flexibility. In the next section, I'm going to show you exactly how your tax bracket fits into this and how choosing the right option can mean the difference between an extra $100,000 or more at retirement. Now let's get into one of the most important parts of this entire decision, your tax bracket strategy, especially if you're pursuing FIRE or financial independence, retire early. A lot of federal employees make the mistake of only looking at their current tax rate. But what really matters is your lifetime tax rate, what you'll pay in total from now through retirement. Let me walk you through a real-world scenario. Let's say you're earning $85,000 right now. You're contributing to the traditional TSP to lower your taxable income. Maybe that brings your adjusted income down to around $75,000. That's great in the short term. You're saving money on taxes today. Now fast forward, you retire at age 50. You've got rental income of around $30,000 a year, plus maybe another $10,000 from a side hustle. That's $40,000 in income before you even touch your TSP. The moment you start pulling money out of your traditional TSP, let's say another $20,000 per year, your total income jumps to $60,000. You're now in a higher tax bracket than you thought you'd be. That could mean more of your Social Security is taxable later on. You phase out of ACA healthcare subsidies before Medicare kicks in, or you cross into a marginal tax bracket that affects everything else. Now let's rewind that same scenario, but this time you had been contributing to a Roth TSP. You retire with the same rental and side hustle income, $40,000, but now, when you need additional funds, you pull from the Roth TSP. Those withdrawals are completely tax-free. Your taxable income stays at $40,000. That could mean lower healthcare costs, better tax efficiency, and fewer surprises. That's the key advantage of Roth when it comes to FIRE, tax bracket control. The earlier you retire, the more important it is to have flexibility in how you draw income. And Roth gives you the ability to take money out without adding to your taxable income. That can be a game changer when you're trying to stretch every dollar in early retirement. Now, of course, not everyone is pursuing FIRE, but even if you plan to retire at a more traditional age, understanding how taxes hit your retirement income is absolutely critical. And that's where Roth and traditional give you two different levers to pull. In the next section, I'm going to show you a side-by-side example of how this plays out over a 30-year career and how one small choice today could add over $100,000 to your retirement balance. Let's put all this into perspective with a simple side-by-side example. We'll assume the same contributions, the same investment returns, and the same time horizon, so you can clearly see how the only variable is whether you chose Roth or traditional. Here's the setup. You contribute $500 per month to your TSP for 30 years. That's $6,000 per year. You earn an average return of 7% per year. We're going to assume you invest the same way, regardless of which tax strategy you choose. At the end of 30 years, your TSP grows to roughly $588,000. Now let's compare outcomes. With the Roth TSP, you already paid taxes on your contributions. That entire $588,000 is yours to keep. There are no taxes due on withdrawals, assuming you meet the qualified distribution rules, which are easy to satisfy if you're at least 59 and a half and have held the account for 5 years. Now let's look at the traditional TSP. Same balance, $588,000. But when you start withdrawing that money, it's all taxed as ordinary income. Let's say you're in the 22% tax bracket in retirement. That means you'll pay approximately $129,000 in taxes over time. So your real after-tax balance is closer to $459,000. That's a $129,000 difference, just based on your tax strategy. And remember, we're assuming everything else is equal. Same contribution, same return, same career length. The only difference was choosing Roth versus traditional. Now, of course, if your tax rate ends up being lower in retirement, say 12% instead of 22%, then traditional might come out ahead, but that's a gamble. Especially when tax rates could rise over time, or if your income in retirement ends up being higher than expected. This is why I always say the Roth TSP gives you certainty. You know that once the taxes are paid up front, the account is yours, tax-free. And when you're planning for retirement, or early retirement, certainty matters. That's the math. But what if you already chose traditional and now you're thinking you might want some of that Roth flexibility? In the next section, we'll go over the Roth conversion strategy, how to shift from traditional to Roth after you leave federal service, and do it in a way that minimizes taxes. All right, so maybe you've been contributing to traditional TSP for years. You're looking at your balance and thinking, I've got a big chunk of money here, but it's all going to be taxed when I retire. Good news, you still have options. And one of the most powerful is a Roth conversion strategy, especially if you're planning to retire early. Here's how it works. Once you separate from federal service, you can roll your traditional TSP into a traditional IRA. That's a direct penalty-free move. You're not taxed yet because you're going from one tax-deferred account to another. Then from that traditional IRA, you can begin converting portions of your balance into a Roth IRA. That's called a Roth conversion. When you do this, you'll pay taxes on the amount you convert in that year, but once it's in the Roth IRA, it grows tax-free and you'll never pay taxes on it again. Now here's where the strategy comes in. If you retire early, you'll probably have a few years with little to no earned income. Those low-income years are your sweet spot for conversions. Let's say you retire at age 50. You don't start drawing your pension until 57. Social Security doesn't kick in until later. Maybe you have some side income or rental properties, but your total taxable income is well below what it was when you were working. You can use that window, let's say from age 50 to 59 and a half, to start converting a portion of your traditional IRA each year. You stay in a low tax bracket and gradually shift your money into the Roth bucket. This does a few important things. First, it gives you future tax-free withdrawals. Second, it reduces your required minimum distributions later in life. And third, it creates flexibility for drawing income without increasing your tax burden during retirement. And best of all, because you're not touching the TSP directly, you avoid early withdrawal penalties. The conversion itself isn't a withdrawal, it's a transfer from one retirement account to another. One word of caution, don't convert too much at once. Large conversions can bump you into higher tax brackets, and that defeats the purpose. The goal is to stay in control of your tax bracket while gradually shifting money into the Roth side. If you're retiring early or planning a gap between federal service and full retirement age, this is one of the smartest moves you can make. Now let's talk about something really practical. You don't have to pick one or the other. In the next section, I'll show you how to split your TSP contributions between Roth and traditional, and why that might be the most flexible strategy of all. Here's the part that surprises a lot of people. You don't actually have to choose just Roth or just traditional TSP. You can split your contributions between the two, and for many people that's the smartest move. Why? Because it gives you what we call tax diversification. Just like we diversify our investments to manage risk, tax diversification means having money in both tax-deferred and tax-free buckets, so you have options later. You get to decide where your retirement income comes from based on what makes the most sense each year. Let me break it down. When you log into your TSP, you can choose the percentage of your contributions that go to Roth and the percentage that go to traditional. For example, you might do 60% Roth, 40% traditional, or maybe 50-50. It's up to you. Here's why this matters. Let's say you're in your mid-30s. You expect your income to grow steadily. You're not sure where taxes are headed in the future. Instead of betting all in on one strategy, splitting your contributions lets you lower some of your tax burden now. With the traditional side, lock in tax-free growth on the Roth side, or keep your retirement withdrawal options wide open. Now fast forward to retirement, maybe you're withdrawing from your traditional TSP up to a certain tax bracket threshold, let's say the 12% bracket. After that, you switch to your Roth TSP for anything extra so you avoid jumping into a higher bracket. That's a real strategy. It lets you fine-tune your taxable income and manage your taxes year by year. Splitting contributions is also a hedge against future tax law changes. We don't know where tax rates will go in 10 or 20 years, but having both types of money gives you control no matter what Congress decides to do. So if you're not sure what to pick, or your situation doesn't clearly lean one way or the other, splitting contributions gives you flexibility without overcommitting to a single tax path. In the final section, I'm going to wrap this all up and give you a clear summary of when each option makes the most sense, and what I recommend based on where you are in your career. All right, let's bring this all together. If you've stuck with me this far, you now understand how both Roth and traditional TSP options work, how taxes impact your retirement strategy, and how to use each one based on your personal situation. So here's my honest recommendation. If you're in the early or middle part of your career, especially if you're in a relatively low tax bracket right now, and you expect your income to rise over time, you should seriously consider leaning toward the Roth TSP. You'll pay the taxes now, but your money will grow tax-free, and you'll have the flexibility to withdraw it tax-free later. That's a huge advantage, especially if you're pursuing FIRE or want more control over your tax situation in retirement. On the other hand, if you're in your peak earning years, or you're just a few years away from retirement and you want to lower your current taxable income to increase cash flow or qualify for deductions, traditional TSP might be the better option. You get the tax break today and defer taxes until you're retired, hopefully in a lower bracket. Now, if you're not sure which way to go, or your situation could change, splitting your contributions between Roth and traditional is a perfectly valid strategy. It gives you tax flexibility and prepares you for whatever retirement scenario plays out. And remember, no one can predict exactly what tax rates will look like 20 years from now. That's why the best strategy is usually the one that balances certainty, flexibility, and alignment with your goals. So here's your action step. Log into your TSP. Check your current contribution settings. Decide if you want to shift toward Roth, traditional, or split them based on what you've learned today. And while you're at it, make sure you're contributing at least 5% to get your full match. That's the baseline. Never leave free money on the table. Now, I want to hear from you. Drop a comment below and let me know. Are you using Roth, traditional, or a combination? And based on today's video, are you planning to change anything? If this video helped you out, hit that like button, subscribe to the channel, and tap the notification bell so you don't miss the next one. I post new videos every week to help federal employees like you make smart decisions and reach financial independence faster. Thanks so much for watching. Take control, stay focused, and I'll see you in the next one.